What's going on, everyone? It's Sean from Predicting Alpha, and we are back at it. So we used to do every single morning live stream analysis of the market, looking at what's going on in the option space, and we are now back at it. We took a little bit of a break while we built out what I'm showing you right now, which is our new option data terminal. It's the new Predicting Alpha terminal, and I'm telling you guys, this is going to be something you want to see. And what we're going to be doing each morning is a couple of different things. Just to recap, in case you are new to the stream, we are going to be breaking down what's going on in the market, starting with an overview of what's moving today, what sectors are moving, what are the big stocks that people are looking at. We're going to be looking at a couple of particular stocks. Today, we're going to be looking at GME, CIEN, Tesla, and DHI. If you have any stock that you want us to look at, let me know and we'll take a look at it. Siddharth Pranav, what's up, guys? How are you doing? It's good to see you guys here. For anyone who watches the replay, those are members of Predicting Alpha. Good guys. So yeah, what are you guys looking at today? Let me know. So let's get started here. Number one thing, if we take a look at SPY, pretty sure markets have touched all-time highs. Let's take a look here. Look at that, guys. Markets, once again, touching all-time highs. Absolutely insane. Markets are just on an absolute tear. And, even though, typically when stocks go up, we see volatility decrease. There's still a lot of opportunity right now. And what we're actually going to be looking at today is a couple of long vol and short vol plays. So opportunities to buy options and opportunities to be selling options. So let's take a look quickly at what sectors are moving. So we can see here, XLE, in terms of the share price, is on an absolute tear today, up 1.95%. And we can see that VNQ is the biggest loser of the day so far, down about 0.8%. The bald guy in the back, it's Jordan. That's my junior quant. He's the one who, he builds these things for me. In terms of big news of the day, everyone's looking at stimulus right now. There's, I think, a $800 billion, $900 billion stimulus deal on the table. So everyone's got their eye on that. Basically, that goes through. Lots of money getting pumped in again. Lots of people getting money. And we should see some smooth sailing for a bit. But we'll keep our eye on that to see how it goes. In terms of stocks we're going to look at today, we have a couple of earnings trades we're going to look at and a couple of non-earnings trades. Earnings events are a really interesting thing for us to be trading because we're going to show you a couple of cool data points that really help us understand what the market is implying. Always remember this when we're looking at the stocks. It's not just what we think is going to happen. It's what we think relative to what the market thinks is going to happen. We always have to keep that in mind because if our view is the same as the market's, there's no trade to be made. The trade comes when there's that disagreement. So let's take a look at an earnings trade to start, and we can take a look there and see if there's any opportunity. So let's take a look at CIEN. CIEN. So take a look at this, all right? We have a couple of different data points we're going to look at. The first that we're going to consider is what move is the market implying right now? What does the market say is going to happen? Okay? And we can see that number right up here. So we extract it out of the option chain, and we can see that the implied move for CIEN, which has earnings, I believe, tomorrow morning. Let's take a look and check. If I type it into my scanner here, we can see that it's on the 10th before market open. We can see that right here. So, and it's confirmed. So tomorrow morning, before the market opens, Ciena is going to be releasing earnings, and the market is currently implying an 8% move for the stock. Now, what data points can we look at to say, is this a fair evaluation of how much this thing is going to move? Well, we can look at a couple of different things, right? Let's zoom in a little bit here. One thing we can look at is what is the average move for this? So if we look back at the last 4 years of earnings, how much does this thing move on average? And what we can see is that the average move is actually 10.5%. Okay? We can go even one step further and say, well, so we have a couple of different data points here. We have what the market is saying is going to happen right now. We have what actually happens on average. And we have another number here, which is what does the market on average say is going to happen? So the average market opinion, the average move that actually happens, and what the market is saying is going to happen now. And we can see a pretty interesting trend here. We can see that the average move is 10.5, yet the market has been consistently understating how big the move is going to be for the stock at 8.6%. So off the bat, we can say the market's on average understating how much this stock is going to move on its earnings event. So going a little bit further here, we can see that we could ask ourselves, well, how would different strategies have performed if we had traded the earnings event historically? So we can say, how would we have done if we had maybe bought a straddle or bought a call or bought a put? And we see some pretty interesting stuff. So buying a straddle would simply be buying volatility, right? We don't have a view on what direction this thing is going to go. And if we take a look at this, we can see that our straddle P&L is actually 200%. So over the last 4 years of earnings, if you had bought straddles around each of the earnings events, you would have been up 200% buying volatility around CIEN. And this is really interesting because on average, we actually see volatility being slightly overpriced around these events. Yet on CIEN, it's underpriced. So this is a really good opportunity for us. We can take a little bit of a look deeper, but off the bat, I'm already saying this is an opportunity to be buying some volatility going into this event. The way I'd be structuring it, by the way, is I would be buying a straddle if I were to just be taking a view on the volatility, and I'd be putting on that trade towards the market close. Because what I want exposure to when I'm trading earnings is I want exposure to the earnings implied move. I'm not really concerned about how the stock moves on a daily basis, and I don't really have a view on it. So I'm going to start my position as close to market close as possible, and then I'm going to wait for that earnings volatility to melt off in the morning or that big move to happen, and then I'm going to get out of it early in the AM. So, but let's take it one step further, right? What if we took a look at how the calls perform, right? What if we didn't buy a straddle, we took a bit of a directional view? How does our position change? So if we click here, take a look at this. If we had bought calls around each of the earnings for CIEN, we would be up 900% in the last 4 years. Huge P&L on the call side. And what about on the put side? Well, we can actually see that the puts haven't been paying off. Isn't this interesting? Most of the earnings events, we see an outperforming move to the upside. So there's really a couple of positions here that we could take. Number one, we could buy a straddle. We could buy an at-the-money straddle. Number two, we could buy a call. Now, what you want to take into consideration here is buying the call has a little bit more risk than buying the straddle, because what if you get that blowout to the downside, right? If you do get that big move, that outperformance move to the downside, the straddle protects you and potentially gives you that opportunity to still make money. Whereas if you just bought the call, you'd be done, right? You'd lose whatever premium you paid out to do it, assuming you traded it correctly, which would be trading the short dated options to maximize your exposure to that earnings move. We can see here the distribution of the earnings moves, right? So what this shows us is the frequency of the move, right? And how big the move is on the x-axis. So what we can see here is the most frequent moves tend to be about, 4%, but very, very similarly, we're seeing moves of 9%, right? It's not a huge difference between the 4 and 9% moves, and the tails are so fat on this. So, I'm really thinking we could see that move here today, and this is an opportunity to be buying some volatility. So let's take a look now at everyone's favorite stock, Tesla, right? Tesla is something that we've actually had a short position in for the last little while. And it's actually still looking like a good opportunity to be short volatility, right? And always remember, for those of you here that might be a little confused when I'm saying short volatility, options are volatility products, meaning that it's not just like I think the stock is going to go up, so let's buy a call. That's the mistake people make at the start, but after getting burned a few times, we usually figure it out pretty quick that something else is going on here. Options take into consideration how much something is going to move in a given period of time. And that is the level of volatility, right? That is the amount of volatility of the stock, how quickly and the size of moves that this thing is having. And when we're looking at Tesla, people tend to stay away from it when it comes to the option space because it is so volatile, right? It moves a lot every day. But remember what we said at the start of this live. If the market thinks it's going to be volatile as well, that's going to be priced in. And what we're really comparing ourselves to in our view too is what does the market think is going to happen versus what do we think is going to happen? It's not just what is actually going on. It's the view of the market versus our view. So for example, for Tesla, if the market was saying there's going to be no volatility, well, it'd probably be a good buy because we think there's going to be some volatility for sure. But as we look at here, we can actually see that the market's implying a volatility of level for the 30-day options of 96%. Right, 96%. That's a pretty high level of volatility. It's a daily 1 day implied move of 5.5% on the stock. We can see today it's only moved 1.82%. And that's not to say Tesla can't move 5% in a day. Yesterday it moved 5 or 6%. But when we averaged out over that 30-day period, our view, given our forecast, which is an ensemble of models used to forecast volatility, we're seeing something a little bit different. The market's implying 96% implied volatility, whereas we think there's going to be 78, 79% volatility. So let's take a look at how implied and realized volatility have moved together in the past, right? So we have the market implied, and then we have what actually happens as well, right? There's always those three. What the market thinks is going to happen, what we think is going to happen, and what actually ends up happening. So right now we're going to take a look at what the market thinks is going to happen versus what has actually happened over, let's say, the last 6 months. And we're going to come down here to do it. So let's change this to 6 months and take a look. So we can see that the implied volatility has, for the most part, outpaced the realized volatility. So even though the stock has moved a ton, right, it's been on an absolute tear, if we remain delta neutral throughout our positions, we would be capturing some of that variance risk premium, some of that baked in volatility in the options. We could take advantage of that and we would have been doing pretty well. And we still have the opportunity to do that right now. Now, obviously, this is not for sure, right? Anything could happen. But based on what we're seeing here, it looks like volatility is expensive. If we come down here, take a look at one of my favorite graphs, which is the volatility cone. And what this does, it really gives us an idea of where is volatility for different expirations relative to where it's been for those expirations historically. And we can see some pretty cool stuff. So off the bat, we're going to do a couple things. So we have this max up here, which is for each of these expirations, what's the maximum volatility we've seen in the last 2 years. But we're actually going to take that off because COVID volatility is a little different. Like the volatility we were seeing in March, for example, it kind of skews our sample. We want a better idea of how things have been moving now and where volatility is right now relative to where it's been, without these extreme outliers. So what I'm going to do is I'm going to remove the maximum and the minimum, leaving us with a couple of different things. In fact, I'm going to take off the median right now just to make a point. We have the first quantile, the third quantile, and we have the current. So the way we can think about it is these two create a range, right? The range between these two is where volatility lies 50% of the time. And if we look from third quantile to zero, that's where volatility is found 75% of the time. So what we can see is that current volatility levels are through the roof. They're extremely high relative to what we typically see for Tesla. In fact, if we throw on the median, which we can use as the average volatility, the actual average, we can see that it's, at the near dated options, it's almost double, right? And as we go out a little bit in time, we're seeing it at about 50% higher. Now, it makes sense that we might see a little more volatility right now, like why the market thinks, it makes sense why the market thinks there will be a little more volatility right now. Well, Tesla's being accepted into the S&P 500, right? That's a big move for the company. There's going to be a lot of buying, and you can see that driving up the share price. And when you see this rapid increase, it makes sense why the market would hold the sentiment that the stock is going to be more volatile. But here's the thing. We actually think that becoming a part of the S&P will bring volatility down a bit, right? There's a whole bunch more liquidity in this market now. There's bigger players holding this thing. And we think that having that could actually cause this level of volatility to decrease. And, as we can see, as we go out in time, the market sort of agrees that as this event comes and goes, we will see that volatility start to come down a little bit. So what our view is here is you could be looking at taking a short volatility play. What we have on is about, we have the February options. We're short the February volatility. So that's another trade that we could look at taking, that you could look at right now, right? Obviously, the thing is, especially with us being in Canada, it's a lot of buying power. This is not a stock that you can really be trading with a small, medium-sized account. Even putting on one lot would be about 50 grand. So, it's a tricky one to play. There's a lot of money on the line, but looks like there's some edge here. So let's take a look at another trade. So this is a short vol opportunity. So if you want to be selling some options here, but let's take a look at another one where it's actually an opportunity to be buying some options. And the stock we're going to look at for that is DHI. So let's take a look here. Ron's asking, the February option, we mean our days to expiration is in February? That's correct. So our expiration is the February monthlies. Okay, so first thing we can do here is let's take a look at what's going on around this stock, right? So if we come to the news and sentiment tab here, we can get an idea of a couple of different things. Number one, how much media coverage there is right now for this stock relative to how much there usually is. If 1 was the average, we can see that right now there's 1.18 media coverage, meaning there's slightly above the usual level of media coverage, meaning the number of articles that are published each week around this company. So we can see here that last week there was 12 articles published, whereas on average there's 9.5 articles published specifically about this company. We can see that there's a decent bit of buzz going on right now, and that the sentiment around this company is huge. Everybody is bullish. The retail sentiment, which is pulled from social media data, is 100%. Every retail trader and their dog is bullish on this thing. And we can also see that the news sentiment is extremely bullish too. So when we pull out keywords from the different articles that are being published about this company, it's extremely good. Everything's positive about this company right now. And this is pretty cool, right? Everyone's bullish. Typically I tend to take the view that if every single retail trader is bullish, it's probably an opportunity to sell, but this is some important information for us to be aware of as we look at what's going on around this company. So let's see if we can find any cool news here. News about the shares rallying. Can we see anything here about events coming up in the near future? Okay, a couple pension funds buying into it. Stock dropped a little bit recently. People may be seeing it as a buying opportunity. Okay, so no major news around this company, except for a couple of big players getting into this stock. So now that we have an idea of a little bit about why people are bullish on this thing and what the actual view in the market is right now, let's head over to Volatility Insights and see what we can see. So stock has been flat today, no move today. And in recent times, it's been pretty flat as well, right? It's trading at $70 right now. If we go to let's say 1 month, let's have a look. It's up about 8% in the last month, which is actually a pretty big move. We can see that the market is implying 38% volatility, which is about a 2% a day move. Whereas we're thinking, given our models, that there's going to be 44% volatility for this stock. So what can we do about this, right? What we're basically saying is, given our models, we think this stock is going to be more volatile than what the market is implying. And whatever we have that disagreement, it's so important to always remember that's where the trade is found. When we have this type of disagreement, we can go out and structure a trade to express our disagreement. So given what I know about this stock, I really don't know what way this thing is going to go. I have no opinion on if this thing's going to go to the moon or if this thing's going to go to zero or how it's going to move in the future. But what I do have a view on is how much this thing is going to move, whether it's up or down. So I can structure a trade to take advantage of that. So let's say I go to Thinkorswim here and I type in DHI. Oh, having a bit of lag. And let's go back to the terminal for a second here. Let's take a look quick. Okay. I probably want to be trading, something a little bit further out. I'm not going to be trading the 10 days to expiration options. I'll probably be looking at something, maybe 30 days out here. Let's take a look. Do we have earnings coming up? Let's go over to earnings analyzer quick. Okay, no, we have earnings out in January. So yeah, I'll probably be trading something about 30 days out right now, one of the monthlies. So let's head back over to Thinkorswim. Let's take a look at the Jan 15. When was the earnings confirmed for again? Let's go back. Earnings was confirmed, or not confirmed yet, for the 25th. Okay, cool. So since I don't have a view on the earnings, it's nice that it's not being priced into this, even though we're pretty far out. So it's not like the earnings event would be driving the level of volatility for this. It would still be priced in if it was included in this time, but it wouldn't be the main driver of it. And what I'd look to be doing here is probably selling just an at-the-money straddle. So we can see that the stock is trading at $71. So I would probably be looking to do something like this. Right? Picking up a 70 straddle for $7.20. So now it's unfortunate that I'm having this little bit of lag here, but hopefully things are okay. And there we go. This is the position that I would be looking to put on. So we can see here that if the stock stays between about, at expiration, if it stays between, 62 and 77, going to be a loser. But if the stock breaks out to either side of those strikes, we're going to have a huge winner on our hands. We can also see if we go here that if the market implied volatility comes up to meet what our forecast is, right? So let's have a look here. Our forecast is 44. So if we see a 6-point increase, now we're pretty far dated, so we might see some change here. Let's come in here. Let's increase this by 6 points. We're going to start making money right away. So if one of a couple of things happens here, we're going to be making some good money. If number one, the stock moves more than the market implied, we're going to be making some money. And number two, if the level of market implied volatility increases towards what we're forecasting, we are also going to be making some money, right? Even if the stock didn't move right now, but let's say tomorrow implied volatility increased by 6 points, we would be up on 10 lots, $1,200 off the bat. So those are really the stocks that I wanted to take a quick look at today. Is there any other stocks that you guys want us to look at? Happy to break down any of the trades that you are looking at today. There's, tons of stuff in the market. We'll do a quick scan while I'm waiting to see if there's anything you want me to take a look at, right? So if we do this quick, right? You can use my scanner at the top here to just take a quick look, see if there's anything that I missed that could be interesting right now. Right, so what I'm doing here is I'm applying filters. So at the start, we're looking at about 880 stocks. And what I'm doing is I'm basically saying, I don't want to be looking at any penny stocks right now. So I want to see something that's above $15 in actual share price. Reason being is if the stock's too small, we're going to be losing out on commissions and on slippage. And a lot of our edge that we could find ends up getting taken away. And I want to make sure that what I'm trading is pretty liquid, right? I don't want to get stuck in a position if I'm short vol, for example. So I put in an average option volume, daily option volume that I want to see of at least 5,000 contracts being traded. The next thing I'm going to do is I'm going to sort the remaining stocks, right? So we went from having 879 that we're looking at to 376. So we've taken the pool of potential candidates and shrunk it down. Now I want to sort that pool based on the market implied volatility versus my forecast of volatility. So what I'm going to do here is click this button here. And as you can see, I can flip it around. When it's flipped like this, it's low implied volatility versus my forecast. And if I click it again, it's high implied volatility versus my forecast. So let's take a look at a couple of trades. Let's take a look at FedEx while we're waiting here. PLL is not liquid, you guess. Let's take a, oh, is it a, yeah, if it's a, yeah, so we don't have it on here right now. We're going to be adding another 1,200 stocks in the near future. We just have a couple more updates we're making to the terminal. But yeah, what's the average option volume on that and what's the price of it? Let's take a look here. So FedEx, we're seeing an implied volatility of 48 and a forecast of 33. So there's a huge spread here. And if I'm not mistaken, correct me if I'm wrong, anyone, it's because FedEx is looking at providing transportation for COVID vaccines. Is that what was driving this increase in implied volatility? Because, you know, if we take a look at, let's say, we take off the max and the min here again, because we don't want to be looking at, you know, COVID times, we can see that it's way above where it usually is, especially for the near dated options. Do we have earnings coming up? Okay, so earnings are coming up too. Implied moves a little higher than the average move for that as well. But we can see here, oh wow, straddle P&L is actually huge for it. Long vol on FedEx around earnings might not be a bad thing as we move forward in time. But we can see that the super near dated options are extremely elevated, right? So as we get closer to the event, if the implied move for the event starts to increase anymore, we could start looking at shorting vol even now going into the event, right? Even the at the monies are extremely pricey for the near dated at 62% implied volatility. So if we want to take a look at what we would do for that, we can come here to Thinkorswim. I want to go check out Thinkorswim again, but it's causing me a lot of issues right now. It's a little laggy. Oh, looks like we went down there for a second. Hopefully we're back on. Okay, looks like we're good. Hopefully we are back. So let's take a look. Maybe this loaded now. All right, there we go. FedEx is popping. So let's say that we wanted to be trading the December 18th options, right? About 10 days out into the future. And our view is that options are expensive. Volatility is overpriced for this stock. And when we take a look at the chain here, or when we take a look at the skew, we can see there's a little bit of call skew, a little bit of put skew, but we could probably still get away with structuring out an iron condor here. So let's take a look at what we can do. So when we're structuring out an iron condor, one of the questions that people always ask is, where do I put the wings? Right? If we're doing an at the money iron condor, we know that we sell a straddle at the money and then we buy the wings for protection so that we're not exposed to, you know, the infinite moves to the upside, right? That unlimited risk potential, or that 100% risk potential to the downside. So what we can do here is, the way that I like to pick my wings is based on a number of standard deviations of moves. And the simplest way to get an idea of where to put them is just to look at what the straddle price is. So right now it's trading at 301. So if I come here and let's say I sell a straddle, right? So the straddle is going for $25. So what I can do now is I can sell the 300 straddle and put my wings about $25 on either side of the at the money. This will allow me to have a balanced fly, and it's a great way to structure my trade. Based on my confidence level, I go either 1 or 2 standard deviations away. So let's structure that out and see what it looks like given 1 standard deviation or 1 straddle price on either side. So iron condor, we have the 2 that we're selling here, right? At 300, and I'm going to change this one to be 300 as well, so that my body is both at the money. And then I'm going to change the call that I buy to be at 325. And I'm going to change the put that I buy to be at 275. So let's analyze this and see what we got. Now this is the trade that I am looking at. So how do we make money on this? Well, a couple of different ways. Number one, as time goes forward, if the stock stays within our break evens, we are going to make money. All right. Another way that we can make money here is if the level of implied volatility starts to come down. So let's take a look. All right, if we're looking at FedEx, we can see that the implied volatility is 48 and our forecast is 33. So let's say we see, a 12-point drop in volatility, or it's pretty near dated. Let's say we see a 7 or 8-point drop in volatility down towards where our forecast is. And we could see that happen if the stock continues not to move, right? It's only moved 0.23% today. It's not moving right now. Now, a lot of this is going to be driven by this earnings event move that's implied, but we could still see a little bit of vol melt off if the stock continues not to move going into this event. So let's say we see, a 5 or 6 point drop. And if we drop the vol by 6%, off the bat, we can see that we would be up $1,000 if we did 10 lots. And then as time moves forward, we start doing very well. So there you have it, everyone. Those are the stocks that I wanted to break down for you this morning. Every single morning moving forward, Monday to Friday, we are going to be doing a live stream like this where we use the data that we have to help give you some insight into the market. If you found this helpful and you found this valuable, please subscribe to our channel. And I really want to say this, right now we only have, if I come over here to our live stream, we have 9 people watching this right now. In the Predicting Alpha community, the number of people who are subscribed to this terminal, there are 65 people. You plus those 65 are the only people in the trading community that have seen a platform like this. Okay? This is the type of data and the things that people look at when they have a Bloomberg terminal, when they're spending $25,000 minimum per year to get data. This is the type of option data that they're looking at. And our mission, our entire thing is to help you be in a position where your hard work actually pays off. This is the type of information that it takes to win. And I encourage you all to check out our website, subscribe to us, and take your trading to the next level. So thanks a lot, and I look forward to seeing you tomorrow on the next live stream. Have a good day, everyone.